Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, May 22, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we had a down day today. So there's a couple of things that we're looking at. And it's interesting because it all depends in every single case of anybody that's looking at the market. It depends on how you choose to see things that determines what you see based on today's activity. I'm going to tell you what I see, and I'm also going to show you what I saw during the day today, which was very interesting. And I think I want to make mention of this because I want to lend kudos to one of the traders out there that was short the Russell 2000. He was short the actual futures contract, the RTY, asked me about it earlier in the morning, told him what I thought. He had the right idea. He had the right stop-loss order, and I'm sure he ended up making money today. So kudos to that trader, and it was absolutely right out of the course that he bought, the Lazy E-mini Trader course, that was able to show him the trade setup, allowing him to get short and allowing him to make money, probably paid for the course in one day. And before we really get into the charts, I also want to make mention that I really do appreciate all the comments on the videos. They're helpful to everybody. Keep the comments coming. You guys are doing an amazing job. You're getting the interaction going, and everybody's able to learn something from all the questions. They're good answers, they're good questions, and they're great topics. So thank you for participating for those of you that do. For those of you that don't, please participate. It's a lot of fun when we get a nice big conversation going about a specific topic. Secondly, I want you to continue to like the videos. It's very helpful. I appreciate everybody that hits the like button. Please continue to do so. It's like paying it forward. I'm paying it forward by spending the time to make as good of videos as I can make. So I really do appreciate everybody that's following suit and paying it forward a little bit. Please like the videos. And lastly, share them with those people you think can benefit from this information. It's very important. I believe in karma. They'll thank you for it, and it'll come back around to you in a positive way. All right, let's go to the charts. So the first thing I want you to notice is we have what might look to some traders as a reversal candle. We had a pseudo doji candle here. We had a pseudo doji candle here. And now we had what may look to some traders as a reversal candle. We never did get above the high on a closing basis from the first pseudo doji candle that was put in last week. We challenged it yesterday. We challenged it again today. Yet we had a pretty decent rollover intraday. So to the naked eye, some traders will look at that candle on the chart and say, that's a reversal candle. To me, it's a down day, but it's not a bona fide reversal candle. Now, here's the deal. That's not to say we won't see more downside activity tomorrow or tomorrow and the following day. That's certainly possible, and I'll get to that in a moment. But keep in mind that the bigger picture is we're still basically just going sideways. Let's not first lose sight of the bigger picture. Even though we had a down day, that doesn't mean the world is ending. And that doesn't mean that this bullish pattern won't play out to the upside. We may just have to come down first, but that's not necessarily going to damage this bullish pattern. I mean, we're well above the 100 period moving average. We're well above the downsloping trend line. We really have to get down below those areas to really damage the bullish pattern that's been developing over the last several sessions. Now, here's a little tidbit right out of the course. And I'm going to show you why, to me, this is not a bona fide reversal candle. And then I'll explain why we could still see downside even though that's the case. So you see where the close was today. The close was 272.61. That's where the spider closed. What was the low of yesterday? Well, the low of yesterday was exactly 272.60. 1 penny below today's close. Now, folks, that's not an accident. It's not a coincidence that the spider closed 1 penny above yesterday's low. They had every opportunity in the book to close it anywhere they wanted. They could have closed it 50 cents below yesterday's low. They chose to close it 1 penny above yesterday's low. that keeps traders guessing. It keeps analysts guessing. It keeps people that follow the numbers guessing. But here's the other side of the situation. Remember, I believe it was yesterday, or if not, the day before. No, it was yesterday. Today's Tuesday. I believe it was yesterday. We saw the market on the daily chart look like it filled a gap, and the gap that was left open from the 18th, and the official fill of that gap is 271.62 in my book. Now, that print, that erroneous wick on the candle from yesterday that went all the way down to fill that gap and then mysteriously today disappeared, I look at that in a way where it's the market's way of kind of hinting of what might be coming. Now, we can't necessarily take a trade based on a wick that goes all the way down and then disappears and a trade never took place. However, if you were here yesterday and you remember me showing you that wick, on second thought, I'm not 100% sure that we discussed it in the video, but it was certainly discussed in the comments. Somebody else picked up on it, and now I can't remember whether we did discuss it in the video, but either way, it did take place. You can go back to the comments from yesterday's video and see the explanation, and that being the case, it mysteriously disappeared today, but I've got that in the back of my mind, and if in fact this market wants to continue lower, I think it's going to fulfill that gap level down at 271.62. At the same time, the market may choose to retest the 100-period moving average. Now, remember, we've been consolidating above the 100-period moving average for several days. We already tested it. While it may hold, there's no guarantee that it will hold, but also you have another safety net with the downsloping trend line below that. You have a lot of support in that area. If the market decides to sell hard, that's in a case where we would come down, we would bust through the downsloping trend line. If we began to close hourly below that trend line and then certainly daily below that trend line, then the moving averages are going to come into play, and then that 266.50 will come into play. None of that stuff is on the table right now. I just want to make sure that we're aware of both sides of the market. There was definitely an intraday rollover today. It's important. I want to take a look at the intraday chart because I think there's a lot to learn. So I think it'll be well worth spending a few minutes on the intraday chart. Now here's the hourly chart. So let's discuss what we have. Yesterday, the market consolidated all day long. That consolidation pattern told us that the likely scenario was higher prices are coming. So the market goes up first thing in the morning today, makes a high of 274.25. Remember, my original resistance line was 275. I moved it down to 274.40 or 274.60. I don't recall. Either way, we came up just short of that. We consolidated all day long. That's a consolidation after making a high, and it was basically an intraday trend change signal. One of the things that's right out of the course, an intraday trend change signal, we'll take a look at that in a minute, that actually took place the first candle of the day, the first 10-minute candle of the day, and then the market proceeded to put in bearish pattern after bearish pattern, and we're going to take a look at that on the 10-minute chart, but you can see what happened. We had a pretty good rollover, and where did the market find support today? At the end of the day, it found support at the 50-period moving average. If it was earlier in the day, I would say we would have had a chance to come back down here and fill that gap we just discussed from the daily chart. We ran out of time, so we may see that take place tomorrow unless the market can gap higher in the morning or at least go higher in the morning and recover some of the very short-term damage that was done. What is that damage? The damage is that the market, the SPY, really needs to get back above 273 if we're going to see any higher prices whatsoever. Below 273 on an hourly chart closing basis, as long as we're closing below 273, it should be bearish. Above 273, it's bullish. That's not into the end of time. That's for the next day or so. Now check this out. Here's a 10-minute chart, and we put in a signal of a trend change. There's two reasons why this was a signal. They're discussed in the course. I'll leave it be for now, but you get the point. Now we started going sideways, and if any trader was willing to take a trade off the first candle of the day, and the first candle of the day can be tough to take a trade from because the market's still settling out. You have traders jockeying for position. You have traders maybe covering positions from yesterday, taking new positions today. So a trade in the first 10 minutes of the day is not necessarily the most preferred trade in the SPY or the S&P 500. Nevertheless, as you can see, any trade that was taken on the short side based on that trend change signal was taken with a very defined stop loss limitation. We never reached the stop loss limitation. Therefore, any trader that took a trade up there basically ticked around the high of the day. So what happened? Well, when you see a big candle like this go down, and the same thing goes on the other side. When you see a big up candle or a big down candle, that's generally the market's way of indicating that's the direction it's likely to take for the foreseeable future. So now what happens? The market starts moving sideways and it starts moving higher. Why does it start moving higher? Because A, we get into a very short-term oversold condition, and also we filled a gap right here. The market got a bounce higher off that gap fill on the 10-minute chart. That was the gap left open from early this morning, from yesterday's close. And the market proceeds to move higher because markets like to test the highs of breakdown candles and the lows of breakout candles. Now, we didn't quite get to the top of this breakdown candle, but we went about 3/4 of the way up and we continued to go sideways. Then we had another little down candle, and look at this bearish pattern that put in. This was a classic bear flag pattern. This was telling us lower prices are coming. And even though they did come, the market tried a little bit of a fake out. But look what happened. The high of this candle, we were never able to get above, maybe for a penny or so, but never really able to get above the high of that last red candle. Certainly didn't close above there, and then we were off to the races on the downside. That was a bearish pattern inside of a bearish pattern, and that, my friends, is how I look at the market, and that's how you can look at the market. You should look at the market. You can learn to look at the market. What I'm giving you here are snippets of information. The entire process, the entire ball of wax is found in my course. And whether we're looking at these type of patterns on a 10-minute chart or an hourly chart or a daily, weekly, or monthly, it doesn't make any difference. They're all going to do the same thing. It's just the duration of the chart. It's going to take longer for that actual chart pattern to play out. So an hourly chart could take all day to play out. It could take a couple of days to play out. A 10-minute chart should play out intraday, and a daily chart will take days or even weeks to play out. That's just the way the market works. So the different time frames define whether you're trading on a short-term basis, you're trying to scalp the market, you're trading for 50 cents, or you're trading for a specific amount, a specific target. If you're a swing trader, you're looking at hourly charts and daily charts for the most part. And then we look at the weeklies and the monthlies for confirmation to make sure we understand where the larger directional trend actually is in whatever we're looking at, whether it's a stock, the major market, commodity, doesn't make any difference. All charts act and react the same way. Now we're looking over at the IWM, and when you look at the daily chart, I can say that's a reversal day. We filled a gap from the other day. It's a big reversal candle in comparison to yesterday. It's a reversal. Now, how much down do we go is the question. So we may come back just to backtest the 160.63. I believe we talked about that yesterday. That's normal and common market behavior. That may be all that's going on. However, we'll know more if in fact we begin closing first hourly and then certainly daily below 160.63, then we could have a failed breakout on our hands and something else entirely. So I'm watching the IWM very closely. The IWM was certainly providing some clues today because it was weak today. It had relative weakness. The IWM was down a little less than 0.75%. The SPY was down 0.25%. So the IWM was certainly leading on the downside, hence the reversal day. And of course, as you know, it's my favorite market leading indicator. So the IWM was weak. Can we gain any evidence or anything that we need to know for tomorrow on the hourly chart? Well, not really, other than the fact that based on the look of this chart, I would be very surprised if we didn't come down and at least test the 50-period moving average. More likely, we're going to test the 160.63. We have to look at both sides of the market. Yes, we had a reversal day. Yes, there may be more downside coming in the IWM, but keep the bigger picture in mind. We just made new highs. We just broke out to new highs. If we come back and retest 160.63 and it holds, that's going to be bullish for the market. So we just have to maintain a perspective. It was a reversal day, but this is not a bearish chart. Those are two different things. A reversal day can mean another couple of down days and that's it, or it may mean the beginning of something more. We don't know yet, so let's not jump to conclusions, but let's understand where we are in the big scheme of things. We're still at new highs minus today's activity. We're still in a bullish position in the IWM by far. We got extended from home base. The 20-period moving average is home base. So what are we doing? We're coming back toward home base. Home base is coming back up toward price. Maybe we go sideways for a while. Maybe price comes down farther and lets home base catch up a little bit. It's not necessarily bearish in the big scheme of things, but there can be some more downside activity. I don't mean to talk out of both sides of my mouth. I just need to make sure that you understand there's a short-term perspective, there's an intermediate-term perspective, there's a longer-term perspective. Very short-term perspective, wouldn't be surprised to see some more downside tomorrow, maybe even Thursday. From an intermediate-term perspective, we're at new highs. We just broke out in the IWM. I'm not ready to call a collapse just yet. We're just a stone's throw away from all-time highs, so we have to put that in perspective. It's a down day so far. Let's check in over at the VIX, and what we see in the VIX, well, the S&P was down 8.5 points, the Dow was down 178 points, the transports, which we'll get to, were down 125. That was a big drop. The NASDAQ was only down 15 points, and the VIX was basically flat. We were up 1%. It's 14 cents. It's closer to a rounding error than anything else. So we're, again, still below the moving averages. If there was some kind of fear in these markets on a day like today when this afternoon we sold off, then you would expect the VIX to have a much bigger rally than it did. However, I will make mention of something. Write this down. We'll double check it tomorrow. But we're coming into a very important culmination of time on this chart. There's a bullish pattern. There is a very defined stop loss limitation based on the current pattern that exists. And we are absolutely in a window of a period of time where we could certainly see a pop higher in the VIX. So if we're going to get further decline across the stock markets, tomorrow and or Thursday, we may see a spike higher in the VIX. We're definitely in the time zone. This is right out of the course. Those of you that took the course know exactly what I'm looking at. It's a pretty easy trade with a very defined stop loss limitation based on this chart. Forget that it's the VIX for a second. Any chart that had this type of pattern with a defined stop loss limitation like I see on this chart is a trade that can be taken. Listen, trading is a business, and just like any other business, when they put a deal on the table, if the deal is good, you take the deal. Not all deals are going to work out perfectly, and sometimes we have to take a small hit or a loss on a deal, but if the deal feels good, smells good, looks good, walks like a duck, talks like a duck, it's probably a duck. Therefore, the majority of these trade setups will work out. Not 100% of the time, but certainly 7 or 8 out of 10 times, this setup's going to work in your favor. Transports, my second favorite market leading indicator. And look what happened today. Yesterday, we broke out of the top portion of this channel, and today we're right back in. And that tells you a couple of things. Number one is we're not ready to break out yet. That's obvious. Number two, we filled the gap that existed from the other day. And number three, we did have a reversal day as well in the transports. So there may be some more downside in the transports. Again, keep everything in perspective. Short term, yes, we can have some more downside. Am I looking for a collapse? Not necessarily. Look where we are. We're above all the moving averages. We're above the 100 period moving average. We were just consolidating sideways above the 100. We started to break out and we're failing. If this is going to be a major league failed breakout coming back down towards the bottom portion of the channel, it's too early to say that's going to be the case, and one day doesn't necessarily make a trend. What I will tell you, and this goes for any of the markets, any of the charts, a close tomorrow below today's low will have meaning. That will likely be a signal of more downside coming. Here's a chart of the XBD, or the broker-dealer index. Just as we talk about market reversals, we talk about downside, we talk about the big picture, we talk about the short-term picture, here we have the financial sector. We're going to take a look also at the XLF in a moment, and we have the financials up today. So there you have a divergence. And of course we have a divergence. They never ever make it easy. Remember, the market's job is to trick, trap, and fool as many traders as possible. But as an index and as a proxy, or somewhat of an indicator, we know that the financials are going to at least pace the market on the downside if we were going to have a hard sell. And likewise, on the other side, the market's unlikely to continue higher without participation from the financial sector. So here we have the financials performing relatively well today, with a lot of markets struggling across the board. Look at the XLF. So the last few days, we were talking about a bullish pattern that was developing underneath the 100 period moving average. And we kept discussing the fact that the longer we consolidate underneath the 100 period moving average, the more likely the story is that the market is consolidating, building energy to get through up and above the 100 period moving average. Well, we started that process today. We'll see if the market can finish it off. I think the XLF really wants to and needs to fill this gap. It will eventually fill that gap. But what I will tell you is, I'm going to go over to the weekly chart because this week's close is going to be extremely, extremely important. If we make a run for this high here from the week ending the 23rd of March, and the high is 29.10, if we close, and that's a far way off from where we are now, the XLF doesn't move that much each and every day, but if we close Friday's close above that level, that will be bullish for the market. Aside from that, or barring that, this is a bearish pattern. This pattern, 8 out of 10 times, 7 out of 10 times, sometimes 9 out of 10 times, is going to play out to the downside, just like this. Not looking for an all-out collapse. I'm just saying that this pattern generally will play out to the downside. If that's occurring, I can rest assured, or we should all be rest assured, that if this pattern is playing out as it should in the financials over time, remember, this is a weekly chart. May not happen this week, may not happen next week, but ultimately, as long as we don't close above this level, this is going to play out to the downside. And if and when that does occur, the other markets are selling along with it. More mixed messages today. So here's the Philadelphia Semiconductor Index, the SOX. All you see here is the same thing that we've been discussing on some of the other charts for a while. The Qs, the SPY. You take today's activity away, and all those other charts from yesterday look just like this. What's this doing? It's just going sideways back and forth above the moving averages, consolidating in a bullish formation, building energy to go higher. Now, we may go lower, but under normal conditions, this market is telling me that it wants to move higher. It was an up day in the SOX. We were up 0.5%. So again, another divergence. We have some mixed signals, and that's why I'm not getting excited about the downside potential in the other markets. We may have another down day or two, but I'm not looking for them to pull the rug out or open the trapdoor or anything like that just yet. I don't see it in the setup from a short-term basis. Moving over to the gold market, we see the same thing today that we saw yesterday. We have a big down move, and we have a bear flag pattern developing. This will generally play out to the downside way more often than not. The issue is we can certainly work our way higher and still be in a bearish wedge pattern. Doesn't change the overall picture if we did this whole pattern, whether it's a flag pattern or a bearish wedge pattern. It's just a different name. At the end of the day, as long as we stay inside from the high of this breakdown candle, this is a bearish chart pattern and will generally have another leg lower. We're also getting into a window of opportunity where that leg lower may show its hand over the next day or two. So keep an eye on that, write that down. If this pattern plays out, you have at least 1270 on the downside, more likely down to this gap area, down around 1260, 1258. Those are the two numbers. Target 1 would be about 1270. Target 2 would be all the way down to fill this gap down here in the gold market. This is the chart of GLD, and the only reason I want to bring this up is I just want to recall, for those of you that have been watching these videos for a while, remember this up here. We flagged that the day after it happened. I didn't see it the day it happened. I saw it the day after. I typically look at gold futures, and I looked at the GLD, saw this, talked about a retrace, and look where we are now, all the way down here at 122. That all took place around 129, give or take. Interesting, to say the least. The actual gold futures chart at the time didn't look the same. They never quite do look the same because of when they trade to and when they officially close for the day versus when GLD closes for the day. GLD is an ETF, closes at 4 o'clock. The futures contracts have different closing times. The pit session closes early afternoon, and then the official close is 6 p.m. Reason I bring this up, and by the way, I was not in this trade. I hate to say it, but I was not in this short trade. But the reason I bring this up is because it was a textbook short. 3 reasons why it was a textbook short. All 3 reasons are discussed, explained in detail in the course. Of course, there's going to be somebody out there saying, well, if you had 3 reasons why it was a short trade, why didn't you take the trade? I'm asking myself the same thing. Crude oil, we had a down day in crude oil. It happens. We're down 22 cents. Not a big deal, 1/3 of 1%. We're still grinding our way. We're above all the moving averages. We're in an uptrend. There's just no two ways about it. This uptrend won't be broken until it's broken, and we're far from it being broken. I still think we get into the hot zone, which begins on the low side at $74 a barrel. That's at the point in which I will be looking for a potential trend change signal. Not necessarily before that, although it could be before that. I'm looking for a trend change signal at any time, but I'm really looking for price to coincide with that taking place. If an important price comes together with an important type of an event on the charts, it increases your probabilities that you're right or correct on the trade. And with that, folks, it's everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.